Good afternoon, everybody, and welcome to our latest webinar, Fix the Odds, Beating the Market with Data-Driven Strategies. As always, a quick disclaimer just to start. This isn't financial advice. Stocks can go down as well as up, and please remember to do your own research. But welcome from me, Megan Boxall, and today joined by Keelan Cooper, who's a financial analyst here at Stockopedia. Keelan will be joining us later in the webinar to talk about some specific case studies, going through some stocks that this study actually flagged as quite interesting. So we'll be coming on to that later in the webinar. Before then, we are going to just quickly run through what this study did, why we did it, and the key findings, what we found really interesting about the study, and then potentially more importantly, how we can take those findings and put them to work to try and make sure that you can use them to improve your investment outcomes. Then we'll move on to the stock analysis with Keelan, as I say, and then the Q&A. So yeah, get in touch with your questions. We've already had a few, which is great. Thank you for the people who've sent in questions pre-webinar, and also for everyone who was engaging with this topic when we posted about it on the site a couple of weeks ago. It's been really good to see everyone's interest in the stats. This has been one of our more stats-heavy pieces of content, and we'll explain why that was later in the webinar. So first of all, why did we do this research? So we talk at Stockopedia quite a lot about the power of factors, the power of screens, the power of systematic investing, and there have been hundreds of studies which have shown quite how powerful these strategies can be. This is an example of one. This is a study that was done by Eugene Farmer and Kenneth French, who talk a lot about factor investing, the power of factors. And this study shown that the quality, value, and momentum factors, which are the factors that we really appreciate value at Stockopedia, it shows quite how much a portfolio which is built with these three factors in mind can outperform the S&P 500. So this was the return. This chart shows the return of the momentum in yellow, extraordinary return of a momentum driven portfolio. The quality in blue and the value in red between 1980 and 2021, and it shows quite to the extent to which that these factor driven strategies beat the S&P 500. We've also shown it in studies that are a bit more specific. This one is a Warren Buffett study. So this one showcased the extent to which a portfolio built with a screen that tried to identify Warren Buffett stocks could actually beat the big man himself. So the green line shows how well those portfolios performed. Those portfolios that were built with these screens that use the Warren Buffett metrics. The blue line is Warren Buffett's performance, and the red line is the performance of the S&P 500. And we talk about it as well. We talk about the power of screens quite a lot. This screenshot shows the performance of some of our guru screens since inception. It shows the performance of using these guru screens for UK stocks. So that top one, the Warren Buffett screen, has returned 425% since inception. So following that screen to the letter would have resulted in some pretty phenomenal returns. But the problem with these studies, and also with us saying, look how wonderfully well our screens perform, is that isn't necessarily practical for individual stock pickers. These results are great, and people should certainly use them in their investing. But if we are individual stock pickers, we are not necessarily that likely to buy the entire screen. As you can see here, this is the same selection of quality screens that we have at Stockopedia that I showed in the slide above. But one of them, the screen of screens, currently is showcasing 51 stocks. So it's very unlikely that you're going to buy them all. There is ultimately a level of discretionary analysis required. And that means the results that you achieve might not necessarily exactly match those of the screen or the strategy that you're using. Now, showing this in terms of like the actual shares that you're buying. So these are 3 share price charts. I'm just going to leave this here for a couple of minutes because I wonder if anyone knows what these 3 shares are. I would be very impressed. A clue is that 2 of them are European stocks and 1 of them is an American stock. So obviously 3 very different fortunes over the 3-year period from the start of 2021 to the end of 2023. I'm going to move away from this this slide now, but yeah, do let me know if anyone recognizes those share price charts. And this is the performance of the portfolio which bought all 3 of those shares. So 51% return over the 3-year period. So a pretty decent return having bought all 3 of those shares. But let's say that you couldn't buy all 3 shares. You screened for the stocks. All 3 came out of the screen, but you only chose to buy 2. Maybe you had a few doubts about one of them. There was that individual element of investing came into the situation. Now, this shows the return of the portfolio if you had bought the 2 lower performing stocks. So the one that really went down quite hard and the other one that was flat. So minus 31% from buying two out of the 3. But then on the other hand, if you had bought the strongly performing stock and the middle performing stock, their return was 112%. So this shows they're neither NVIDIA or Adobe, but thank you for your guesses. I will tell you in a minute what they are. But this, yeah, shows the power that level of discretionary analysis can have in changing the outcome of your returns. So these 3 stocks are Novo, yes, congratulations, Robert Meadows. Novo Nordisk, 222% over from the start of 2021 to the end of 2023. The flat share is Tesla, and the one that has completely collapsed is Orsted. The interesting thing about these 3 shares as well is they actually did come out of a screen that I set up in 2020 to try and identify megatrend stocks. So there were a few quantitative metrics in the screen as well, profitable companies, growing companies. But the strategy that I was looking at was these so-called megatrends, companies that are benefiting from big things that are happening in the world. So Novo Nordisk is a pharmaceutical company which is looking to revolutionize the way that we treat obesity. Tesla, obviously, electric vehicles, and Orsted is a renewable energies company. So all 3 of them did actually come out of a screen. Unfortunately, the portfolio did buy all 3. Orsted has been a very bad contributor to that portfolio, but this also shows the importance of diversification, not picking a portfolio with just 3 stocks in. It had a lot more stocks in this portfolio. Diversification is a topic for another day. But the lesson here, really, for the sake of this webinar, is showing the power that having that level of discretionary analysis could have on the returns of a portfolio. So with that in mind, we decided to have a look at how these strategies and screens could perform in real life. And in order to do that, we used our data. We've got lots of data at Stockopedia, and we're also quite fortunate that we've got quite a lot of people who know an awful lot about using that data and about statistics. So the first step in this study was to set up the screens. So we chose 3 screens that related to these strategies, which are quite common. So a quality, a value, and a growth strategy. The screens we set up, we didn't want them to be too tight. We didn't want the number of options to be too narrow, because we wanted to test these overall strategies rather than a specific screen. So they're quite broad. They were churning out sort of between 50 and 100 stocks. So having set up those screens, we employed the use of one of our software engineers. So a shout out here to Gavin Grenville Hunt, who model set up all of the simulation. So what this simulation then did was buy 20 stocks, invested £25,000 in each stock, and then at the end of the year it sold them, rebalanced them, and bought another 20 stocks, equally balanced, with the money that was in the portfolio, and bought the stocks that were qualifying at that point. So it was at the start of every year that we did that rebalancing. So after 1 year, the returns were a certain amount, and then we repeated that for over the entire 8-year period that we studied here. So this chart here shows the returns of one portfolio. So that's cool, that's fine. This portfolio returned about 40%. But the problem with just picking one portfolio of randomly selected stocks, which came out of the screen, was that it's very hard to tell, well, it's impossible to tell whether or not that return is actually reflective of the, and is normal for this strategy. So I'll show this by doing another couple of runs of the random simulation. So this shows exactly the same screen, exactly the same strategy, randomly selecting 20 stocks every single year, and it shows the different returns from the exact same strategy. So this shows. Somebody said they've lost connection to me. Cool. Yeah. Is it back? Keelan, am I here?
Yeah,
we're good. Cool. That's good. I'll just go back to the start of this slide just in case, because there was a comment about lost connection. Okay, so seem to be all okay. So yeah, so this slide shows the difference in returns from 3 portfolios that were doing exactly the same thing. 3 portfolios that were selecting stocks every single year that came out of the same screen, but randomly selecting those stocks. And as you can see, the performance was vastly different. So this shows the importance of doing this, of running these portfolios multiple times. So what happens when you do when you run the strategy 100 times? So this, I mean, we can't put 100 share price charts or portfolio performance charts in a line chart. So we're plotting this as the overall return after the 8-year period on a histogram. Again, this doesn't show us an awful lot because that distribution is very strange. It's very random. There's one massive outperformer, and then it's not 100 runs, 100 rolls of the dice was not enough. And so we ran the simulations 10,000 times, which has allowed us to properly analyze the returns of the portfolio and the returns of the strategy if you were to run this strategy and randomly select stocks. So the reason for selecting these stocks randomly was really because we wanted to focus on the strength of the screening rules rather than the individual investment choices. And that comes back again to the importance of doing this 10,000 times and selecting the stocks randomly. So hopefully the results that we've generated have provided us now with some useful insights that we can take forward into our investing. And they really did. So I will now just quickly run through some of the key findings. So having generated all of these results, loads and loads and loads of data, we wanted to plot these. So we plotted them firstly on histogram, and then secondly on this box and whisker diagram. Just showing you here what all the lines mean, just in case you are not familiar with the box and whisker diagram. I hadn't looked at it since I was at school, so I needed a bit of a refresher of the box and whisker diagram when we first put these together. But overall, what the results that I'm about to show you will show the median performance is that green line in the middle, And then the blue box shows the 25th to 75th percentile. And then the whiskers show the full range. But it shows the full range excluding any outliers. And that's significant because there were some significant outliers. As you can see from this particular example, all of the outliers were to the top. They were all outperforming outliers. And Keelan's actually going to show you so some of the case studies that he'll talk to you about will also show the importance, show why it's important to exclude those outliers. So on to the actual results. So these are the results of the original screens that we ran, the quality, value, and momentum. And they show that the quality strategy actually, and this was quite surprising, had a higher chance of selecting winners. The median performance of that portfolio was 41%, compared to 19% for the value and -3% for the growth portfolio. What was probably less surprising was that the downside risk was also better for the quality portfolio. So there's only a 4% chance of loss in the portfolios that were generated using the quality screen, and the very worst return was -31%. So that very worst return fell to 40% for the value portfolio and -61% for the growth portfolio. And in both of those portfolios as well, the chance of loss was greater. So yeah, I guess that's not particularly surprising. Then with this in mind, we thought maybe it would be interesting to see what adding a quality fallback, I guess, to the value and the growth screens would do to the results of those screens, those strategies. And it had a very positive result. So for the value strategy, adding those quality metrics, adding that quality sort of fallback to the screen, both improved the probability of selecting a winner, that the median was slightly higher, and that interquartile range, the 25th to 75th%, was slightly higher as well, and it reduced the chance of loss. As you can see from this diagram, though, if you include the outliers, the very, very best performing stock in the value portfolio was better than the very best performing portfolio in the value strategy was better than the very, very best performing portfolio in the quality value strategy. So there are these massive returns to be made in a pure value strategy, but just adding that quality fallback in reduced the chance of having a losing portfolio. And the same was true for the growth portfolio, and actually to an even larger extent. The pure growth portfolio wasn't particularly strongly performing. It actually underperformed the FTSE All Share, which is that dotted line across the middle. But the adding those quality metrics to the same screen massively improved the outcome. So what can we do with this information? The first thing to think about is how we can use these results to help you pick a strategy that works for you and for your investment requirements. So all of these portfolios, all of these screens actually ended up creating a number of very, very high performing portfolios. So whether it was value, growth or quality, there is still the possibility of doing extremely well. So these were the top performing portfolios simulated from each of these three strategies, both including and excluding the outlier. But the thing that's important, the thing that's significant here, is that your ability to land those big wins is based on your discretionary stock analysis, your experience, the amount of time you have, and the amount of time you can dedicate to actually doing the investing, analysing the stocks. But with the quality screen, the odds of finding those winning portfolios is higher. So the point in that is, if you are an inexperienced investor, if you have maybe low faith in your analysis and stock picking ability, adding that quality safety net can help improve the odds of outperformance. We have got more information online about selecting the right strategy for you and your investment mindset. That's in the Academy as well. We can ping a link after the webinar for anyone who wants to read that. So here we have actually had some questions. What about momentum? So in all honesty, we did actually, in the original simulation, we did actually study momentum, we looked at it, but the results were all quite odd. And we realized that the reason for that is that the rebalance period is quite significantly different from momentum. If you want to pursue a momentum strategy, you're probably looking more likely at rebalancing every 6 months, maybe even less than that, because the momentum strategy works better over shorter periods. So it was quite difficult to compare those results with the quality, value, and the growth. So again, coming back to your mindset, your investment mindset, if you are thinking realistically, you're not going to be able to look at your returns, make decisions on a really regular basis, then you probably want to leave the momentum factor, and look at some of the other factors. So the next follow-up thing that you can learn is actually how to set up these screens. And what I'm going to do here is quickly share my screen to show you how you can set up your own screens doing this within Stockopedia. So obviously this is Stockopedia. What I will show you is setting up the quality growth screen, because that was the best performing one. So obviously in the screening section of the website, you want to add your rules. So we actually there are so many screening criteria. We've got over 350 screening criteria. So have a browse, look for the ones that you want. So, but just to show you how to set up the quality growth one. Profile, we wanted stocks from the UK. So I'm going to scroll down and click the UK. We also wanted stocks which had more than a market capitalization of more than 50 million. So selecting size and market cap greater than 50. And then for the quality part of this screen, so you can go into the quality here and browse what we've got, or you can search for metrics. So I know what I'm after here, so I can search up here, operating profit margin, and I want the time period to be the 5-year average. So I will add that rule. I'm looking for stocks that have a 5-year average operating profit margin of more than 10%. And the same with the return on capital employed. 5-year average of more than 10%. And then the growth element of this. So I was looking at operating profit growth. Operating profit growth over the last 12 months. So companies that are currently growing. And I was looking for stocks which had an operating profit growth of at least 5%. So then you can save the screen, growth, and have a look at the results. So 75 results at the moment, an interesting mix, a few in there that might be worth having a closer look at. But going back to the whole purpose of this study, I'm not going to buy all 75 stocks. Okay, so back to the presentation. So that is one way of using Stockopedia to set up your screen. Another way is obviously using our StockRanks. So I'm sure subscribers are very familiar with our StockRanks. These are our algorithms, our proprietary algorithms that help you that help you to screen the market for these companies, that identify the quality, value, and momentum. They come together as a whole in the high in the stock rank, in the whole stock rank, which takes into account all three of those different factors. But if you are intent on pursuing a strategy that focuses on just one of those, you can use the individual ranks as well. So the quality rank, the value rank, and the momentum rank. And these next 3 slides just show you the ratios that go into these ranks. It's obviously quite a lot of ratios. And this is quite interesting. So the quality rank includes 9 different ratios. And then there's a load for the value rank as well, and a load for the momentum rank. These slides will all be shared so you can have a look at these in more detail. But the thing that's quite useful about this is if you were to set up a screen with all of these metrics in, you probably wouldn't get that many results. But because the stock ranks are based on a ranking system, you're always going to get results. There's always going to be stocks that come out of your screen. So if you set up a screen that looks for stocks that qualify, that are the highest momentum ranked stocks, let's say a momentum rank of more than 90, you'll have a number of stocks to choose from there. So they're the stock ranks are a very good way of setting up that screen, of getting you going. They're also a real time saver as well. So having set up your screen, having decided that you've got your list of stocks that you are going to start selecting from, you want to do your discretionary analysis. So I will now hand over to Keelan, who will show you how he did this for some of the stocks that actually came out of the study that actually were selected by the screen when we did the random portfolio simulation.
Hi everyone. So just to provide a bit of background about Plus 500. So it's a leverage products provider. So it provides contracts for difference internationally. So it allows you to speculate on the on assets without actually underlyingly owning the asset. So if we have a look at the company, it's quite a controversial company, but it's been a persistently high StockRanks stock. So at the start of 2017, when it went into the quality growth portfolio, it had a range of like excellent measures. So if you had a look at the price to earnings ratio, it was at 5.4. The price to earnings growth was at 0.7, and we like to see companies below 1 for that. And the EV to EBITDA, which is the enterprise value compared to the EBITDA, which I don't really like as a measure too much, but it's great to see the cash profile being taken into account there. That was at 3.24. So it could use the EBITDA 3.24 times to pay back the enterprise value of the company. Then with regards to the quality fundamentals, we were looking for a 5-year average ROCE of above 10% and the operating margins above 10% as well on a 5-year basis. Now, if you looked at the stock report at the time, so this is using the historical stock reports, by the way, you can see that the ROCE figures were, I don't know if you can zoom in a little bit, Megan, it's on the right there, 150% and 114% respectively. Now, we also like to see improving fundamentals, and you can see that the health trend was 7 out of 9. So this points to improving efficiency, productivity, and liquidity measures, its ability to repay short-term obligations, and all those things that we like to see. So Megan, wait, I can move the slides. Cool. Awesome. So you could also see from the stock report the rapid EPS growth over the last few years. So over a 6-year basis, you could see a compound annual growth rate of 65% there, which is quite amazing. And then if you look towards the bottom right there, you can always see the 3-year compound annual growth rate, and that was at 78%. So this was a company really growing quite aggressively and still had those excellent quality metrics. So if you had a look at the ROCE on a longer term basis on those 6 years, you can see that it's well in excess of that 10% originally in the screen. The return on assets, return on equity, and the operating margins were at like industry leading levels. So this is like the kind of discretionary analysis which allows you to distinguish between those really high quality companies and just normal quality companies, and improve your chances of picking those stocks which are really going to drive the portfolio gains. So on the next slide, so it's important to obviously look at the quantitative side of things, but also the qualitative side. So going through the trading updates, the trading statements, seeing what the company management is saying about results. And the key thing here is to look for the ahead of expectations. And I think Plus 500 ended up reporting like 3 or 4 times throughout the year that trading was ahead of expectations. And so I've highlighted it in the report there. And another thing is to always look at the key KPIs for the company. So you can see that the number of active users in the table there was growing quite rapidly. The average revenue per user was also growing. And these are all great signs of a company. So on the next slide, you can also see the confidence in management outlook. So if companies are confident in their outlook, they'll be increasing dividends, initiating share buybacks. And so it's great to see these kind of announcements. And I think they doubled their shareholder returns that year. So I think from the first day in 2017, when they started their share buybacks, since then, the company's returned over 500 million in share buybacks, excluding dividend payments, which is more than the market cap of the company. So Plus 500 also adopted aggressive yet effective marketing strategies to propel its growth. And I remember seeing the Plus 500 on the Atletico Madrid shirts back in 2017. And also its partnerships with Brumbies in Australia was really aggressive. And then it retargeted people who were looking for those with ads on Google. I remember seeing Plus 500 all over my feed for a good year. So yeah, these qualitative aspects are really important to evaluate as well. And yeah, if you go onto the company's investor relations page, where you can see its RNS feed, you can see that the company was purchasing its own shares on a daily basis. These are the kind of announcements you want to be seeing from a company. So just in terms of a checklist, a green flag checklist, it had robust quality fundamentals, excellent growth and valuation ratios, expectation beating results, as I said, 3 or 4 times throughout the year, and regular share buybacks. It had a really progressive shareholder returns policy, really confident management outlook, great marketing strategies, and the industry was doing quite well at the time as well. So all great things to look for when you're carrying out your discretionary analysis. Again, to just try and improve your chances of getting those portfolio makers. So if we move on to the next case study, this was in the value portfolio and is an example of the kind of things, what kind of research you want to carry out to avoid getting these companies in your portfolio, like the kind of red flags that would come up from discretionary analysis. So the company had really poor momentum at the start of, I think it was 2019 when this went into the portfolio. It had a shocking 2018 where the share price had fallen from £9 to just below £4 by the end of it. But obviously, you look at that and you think the valuation's starting to look quite attractive. Price to earnings ratio was below 4, and all these other valuation metrics are quite attractive. But then again, if it's too good to be true, it often is, and that's what we'll evaluate here. So the quality metrics, Kier Group operates in the construction industry. It has large margin contracts with government and provides all these facilities. Now, this is a really low margin industry, so margin pressure is always going to be there. So if you have a few contracts that fall through, that kind of thing, it really does affect the company, its cash flow abilities and everything. You can see the price to earnings ratio was quite good there, but the price to free cash flow was nowhere near as good as the price to earnings ratio. There were other liquidity concerns as well. The current ratio and the quick ratio were both below 1, highlighting its abilities to meet its short-term obligations were a concern. And then there were other aspects on the stock report that highlighted a few issues. The operating margins over a 5-year period, along with the other quality metrics, were really quite fluctuating. They were at really low levels, weren't consistent, and yeah, volatile. The balance sheet strength as well was concerned. You could see the net debt pile was growing. It had reached 200 million in 2018, which I think was about a third of the market cap at the time. The average shares were also increasing, highlighting shareholder dilution. If you see you can see the average shares in issue below in the financial summary of any stock report, and it's really important to look at that to see if management are diluting shareholders. It's often a sign of issues below. So if you look at the broker consensus trend as well, you could see that brokers were consistently revising their expectations downwards as a result of all the headwinds that the company was facing at the time. So if we move on to the qualitative aspect of the research, one of the things that you really don't want to see in the news announcements is repeated managerial departures, changes, or resignations. And during that year, CEO Hayden Mursell resigned that year. And there were a few other management changes, director changes. And these are, if it's planned changes, it's fine. But as a result of these managerial changes, it masks issues that are under the foundations. And so if you go onto the investor relations page again each time, you can see the different types of announcements. And it's really important to go through this because you can see recent trading updates, if the trading has been ahead or below or in line with expectations. You can also see the managerial departures or incomings. You can see the share notices and capital structure to see if it's diluting or having to make any changes with regard to its debt obligations, and see all these other key aspects. So another thing here with the qualitative research, doing research on the industry itself is really important. And you could see, if you just looked at the construction sector at the time, that there were a lot of headwinds in the industry. Keelan, which was one of Kier Group's main competitors, ended up collapsing. And unless Kier Group had some ridiculous competitive advantage at the time, it was also likely to face those kind of struggles. So yeah, these are just a few of the red flags here. So you want to make sure that the momentum is not on a downward spiral as it was with regards to the share price and the earnings momentum as well. The quality, you don't want to see operating margins which are volatile or very low, because anything that goes through could lead to losses. Cash flows is another key thing to look at there. Liquidity concerns, whether it's able to meet its short and long-term obligations. The management changes, you don't want to see a revolving door when it comes to management, and you don't want to see an industry facing struggles or peers going bust. So yeah, that was Kier Group, and it shows that in the value portfolio, we did have these outliers. And so by carrying out this discretionary research, looking at the stock report at the time, looking at its qualitative aspects as well, you could avoid these kind of companies and overall improve your portfolio returns. I think that's it.
Yeah, absolutely. Thanks for running through those, Keelan. I think those are two really interesting case studies that you've picked out, because as you say, especially with that Kier Group one, it obviously came out of the value screen. Its valuation metrics were
yeah, the price to book was like 1.1. The price to sales were like 0.1 as well. For any hardcore devout value investor, and I'm a value investor as well, it was really quite attractive. But you can't really catch these falling knives. Whenever you see a profit warning, it should really siren these red flags. I think our profit warning survival guide that we did back in 2016 highlighted that I think it was 11% of companies report 3 profit warnings in a go. And so when you see one, just because the valuation is attractive, you need to still look at the quality, the momentum, the growth potential, and evaluate these other aspects to avoid sitting on hefty losses in the end.
Yeah, absolutely. So before we come on to the Q&A, and I thank you for people who've been pinging us questions, just wanted to ask you, Keelan, about these stocks now. I mean, Kier Group in particular is actually, again, quite an interesting one in reference to this. There's these case studies as well, because fortunes seem to be turning a bit for the company. So do you mind just talking us through quickly about what the investment case is looking like for Kier Group and plus 500?
Absolutely. So, I mean, it's survival of the fittest at the end of the day in the construction sector back in 2018. And Kier Group has done a really good job of paying down its really high debt levels. It was really important that it focuses on this to make sure that it does survive. They got new management in. They focused on reducing costs, reducing unprofitable contracts, closing down areas that were unprofitable for them. So they carry out a range of activities in the construction sector. UK government is a main contractor with them, and they really have thin margins. So by focusing on just the profitable aspects, they've been able to really turn things around, meet their debt obligations, start paying down debt, and stop issuing equity as well. If you go to the stock report to the bottom now, you can see that if you just hover over the net shares, well, the shares in issue, the average shares in issue in the financial summary section at the bottom. If you go to the net debt bit, yeah, if you just go above there, you can see, you'll be able to see, yeah, the average shares there. You can see that starting to come back down again, which is great. After all the dilutionary funding that they've had to do in recent years, you can see the cash position there growing, the net debt falling there. If you just hover just below, yeah, so that's coming down as well now, which is great to see. The margins are still under pressure. It's not a highly profitable industry, but the cash flow situation is entirely different now. So if you go to the price to free cash flow at the top right, in the growth and valuation box, yeah. So you'll see the price to free cash flow there is really, really attractive, 2.4, way below the price to earnings ratio as well. And it highlights how the company's been able to improve its whole operating model and produce these high levels of free cash flow, which has allowed it to pay down debt. I think it's recommenced dividend payments as well. And so, yeah, this is the company that's managed to turn around its fortunes unbelievably well over the last few years. And I think along with the rest of the sector, I know that Costain is another great pick. It's not a great industry to be, it's a cyclical industry. It's not an industry to hold for decades, but it's a really interesting turnaround play now.
So David Carl has just asked us, would our analysis have identified its turnaround? Not sure about whether or not. I mean, I think the valuation metrics, it would have still been being picked up by the valuation screen, because it's still not a bad value company. But as you can see up here, the stock rank has now massively improved. That has improved because the momentum rank has improved. quality is still, I mean, it's not terrible, but it's not brilliant. But overall, the stock rank is significantly better than where it was when it was a real laggard of the sector.
Yeah.
And you can see the stock rank history in the charts.
So let's have a look at when it first entered. So that's when back in 2022. That's the first time it entered. Dropped again, and yeah, you can see the turnaround from after that point.
Yeah, absolutely. And plus 500, another one that Keelan, I know you're quite interested in.
Yeah, I'm quite a big fan of all the leverage products providers. I think they're a great hedge against volatility, to be honest. And I know that plus 500, in terms of a shareholder returns policy, is probably one of the best companies on the UK market over the last decade. I think if you head over to the investor relations site and click on the total shareholder return, let me just get that out quite quickly. It has returned. Okay, over the last 15 years, it's done a total return of 3,750%. Now, for the UK market, that's pretty incredible. It has its fair share of controversies. Obviously, all the leverage products providers are under scrutiny from the regulators. A lot of people do lose money on spread bets, CFDs, so it is subject to regulationary changes. And Megan, if you click on the 5-year chart there, or 10-year chart, yeah, 10-year, better. Yeah, you can see those drops in share price, and those are often because of regulatory changes impacting upon results, or the announcements themselves affecting the shares. So it's something to bear in mind when you are investing in these companies. But if you're investing throughout a decade, they do incredibly well, are incredibly generous to shareholders with their returns policies, and are a great hedge against volatility. But let's look at the quality metrics still. This is the one thing that stands out for plus 500. It's persistent quality. Throughout time, it's managed to generate these ridiculous returns on capital and convert that into cash for its shareholders. Not many companies like it on the UK market.
Yeah, those return on capital employed, which is a metric that we really like to look at for assessing quality companies, that is high, but it's coming down. Is that something that's an issue for you, Keelan?
More consistent levels. I think they had like super normal profits for a few years whilst the regulations didn't come into play and everything. And I think all the leverage product providers are like moving into safer, less risky positionings. They have to have better risk management now, and obviously that eats into profitability, but more certain and stable operations for them as well.
Also,
one thing that is concerning there is the health trend isn't improving. Petrosky F-score there is that 4? Yeah. If you want to click on that quickly, let's have a look at what. So its ability, it's not more profitable. Yeah, it's had a few years of super normal profits though. I think IG and CMC markets as well had really, really strong 2022. I mean, after the pandemic and the interest in the markets that spiked, all of these companies in the industry were doing really, really well, and everything's dropped off to a more normal rate since then. I know that CMC and IG have had to focus on cost reductions over the last year. They've also all diversified their operations a little bit. I know that CMC has Australian assets now, which are focused on normal brokerage operations. So yeah, I think it's just normal for operations to come down and profits to come down to more normal levels.
These are the kind of questions that you want to be asking yourself, don't you, before investing, being comfortable with these levels. If there are explanations, I mean, one thing that I'm certainly guilty of is explaining away issues of companies that I like. Somebody flagged earlier that is one of the stocks, Adobe. I clearly talk about Adobe quite a lot. Everyone seems to know that Adobe is one of my
the greatest company.
I did. I wrote earlier this week that it was the best company in the world. And I am very much guilty of explaining away any issues that are at Adobe. I did actually ask our head of design about his use of Adobe this week. So I will update the article based on what he told me about his actual as a consumer of Adobe.
Yeah, just a quick note on that, guys. We've got the week ahead article at the moment, which we've been testing out, and we'll be covering more US and international stocks in that as well. So if that's something of interest to you, then always check that out.
Absolutely. So moving on to other questions, we've got about 15 minutes left, so we'll try and whiz through some of these as quickly as we can. Firstly, a question that somebody asked before the recording started. John Randall asked, do the share price return stats include dividend payments? I would think that dividends are more likely to make a significant difference to the value orientated portfolios. Really good point. No, we haven't included the income, the total returns in the results of this of these portfolios. But this is definitely something we would like to look into doing in the future. But you're absolutely right to flag that for some of these portfolios, the income contribution would be greater, and that's certainly true for a value portfolio. I mean, income, if you're selecting stocks based on yield, that is a valuation metric, really. So yeah, that's a really good point to make, and it comes back to, I guess, that point as well about selecting your strategy, making sure you think about what the right strategy for you and your investment requirements. So thank you for that question. We've also had some specific questions about some stocks. We've sort of covered the Kier and the plus 500, but a question from Harry Crane about a difference between momentum and growth and how they're used in Stockopedia. Keelan, do you want to take that one?
Yeah, so the momentum rank is really split into two aspects of momentum. There's the price momentum, so the relative strength versus the market, how far it is from its 52-week high, and then it's the earnings momentum element. So you want to see brokers consistently upgrading their forecasts. I know that the earnings surprise is also a factor of that. So basically, when companies report their EPS, how much they surprise the market while the consensus buy. So these are two really key aspects that make up the momentum rank. And so you want to see improving price, and you also want to see an upward trajectory when it comes to EPS estimates. For the growth aspect, we also do use EPS, but we also use sales, operating profit growth. Those kind of metrics are also included in that. Less so on the price momentum side. We don't really involve price that much when it comes to those.
Mm-hmm.
There was an interesting one I saw as well by Tony on the FAMA French applying equally to UK stocks. Do you want to answer that?
Yeah, so it's obviously the study that I showed this screenshot of earlier, that was a US study in comparison to the S&P 500. I can't imagine the returns were quite so strong for UK stocks, but in general, the principles do apply. The same principles apply in the UK. So momentum is an extremely strong performer in the UK, value and quality as well. And we've shown that with our StockRanks. So that's the same sort of trends that we've seen. Our StockRanks, which are based on the same quality, value, and momentum factors, they do outperform the UK markets, and they have outperformed the UK markets since Stockopedia started.
Yeah, just one caveat on that as well. We've seen that quality and value have been like the stronger factors in the UK over the last decade, whereas there's a tilt towards momentum and growth and quality in the US. So obviously different factors work in different jurisdictions, but yeah, they do apply. The factor principles do apply across geographies.
And that actually leads us on quite nicely to another question we got pre-webinar, which flagged the fact that Ed has talked a lot about the merit of a value momentum strategy, whereas we talk in this study about quality and growth being an outperforming strategy. So this is quite an interesting question, because you're right to bring it up. Value and momentum has been a very strong performer as a whole. So for all stocks that are qualifying for value and momentum, they have outperformed. But what this study was trying to do was really showcase what that means practically. And of course, any investor, especially an investor with skills, could have run a value and momentum strategy over the last 10, 20 years and massively outperformed, because the opportunities were there for massive outperformance. But what we found with this is that value, so not momentum, but value and growth, also have a higher chance of loss. So it's not about the ability, then it's not about the performance of the screens, it's about your ability as an individual investor. So we're saying here that if you are maybe not as confident, maybe you're not as experienced, having those those quality ratios in the last sort of 10 years could have helped investors avoid those really calamitous losses, which are the things that can really, really hurt a portfolio's performance. And interestingly, they haven't sort of capped the potential in the UK. I feel like potentially they might have capped the potential in the US. Obviously, the study was just a UK focused study, so it'd be quite interesting to see that. Although that being said, now that I've said that, some of the best performing companies in the US have been the highest quality companies. So yeah, we'd like to run a similar study in the US. But yeah, I hope that sort of answers that question. It's not value and momentum, still very, very high performing strategies, high performing screens. But if you want to reduce the risk, potentially adding some quality ratios in there could be helpful. Another question for Keelan. So for absolute beginners, which quality indicators might suit an individual investor's desired strategy? So I guess that question is really like, which quality metrics should we be looking for?
I think that the first principle, and this is the most widely used one in academic literature as well, is the ROCE, the return on capital employed. It's really important to see, or I think the Americans use the term return on invested capital. It's really important to see what the returns a company is able to generate from the cash it invests. And I think that's probably your go-to principle. And looking at that, not just on a trading 12-month basis or a 1-year basis, looking at that stretch over the last 5 or 10 years is really, really ideal to see companies throughout the economic cycle, what kind of returns they're able to generate. There are a lot of industries where they might have a great year, generate a ROCE of 50%, but the next year it goes to a negative ROCE. So you really want to see those measures over time. And another thing is you can see, this is not for novices, but when you want to get more advanced screening rules, you can also compare the ROCE compared to its industry group as a whole. So you can see companies that might have a competitive advantage that way because they're able to consistently generate ROCEs in excess of the industry average or median. So,
and yeah. I would just add to that as well, if you are a complete beginner, the quality rank, using Stockopedia's quality rank can 100% help with that. So if you're not sure what metrics to use, if you're not sure what ratios to use, quality rank encompasses them all. So yeah, that if you are a beginner is a good starting point. But yeah, you're right, Keelan. I do like the return on capital employed. It's a good.
Yeah. And I know Warren also looks at the return on equity, and looking at all these measures on a more long-term basis is really quite important as well.
Absolutely right. A couple more. So a couple of specific questions about the actual study. A question about how we define the outliers. Yes, there was a statistical cutoff, and I do know he's listening. So Gav, do you mind pinging me the answer, and I will read it out while I answer the question. Sorry?
It's Gav's time to shine in the comments.
Yeah. There we go. He's already done it. It is 1.5 times the interquartile range. So the interquartile range, as we showed in that Boxall diagram, was the 25th to the 75th percentile. So doing 1.5 times that gave us the full range excluding outliers. And then anything that fell either above or below that, it was mainly above, was deemed an outlier. So that's a classic statistical thing to do. There were too many transactions to check this manually. Obviously, in an ideal world, we'd have gone through every single one to try and check which ones were outliers, which ones were real, which ones weren't real, or which ones were realistic. Sorry, but there were 10.8 million buys that were done across the whole simulation, so we couldn't check them all.
Just one from Philip, over what period these gains are. The study started recording from December 2015, Megan, and then it finished it in December 2023. Is that correct? Mm-hmm. And you rebalance every year on that same date in December, end of December.
Yeah, so that kind of leads on to another question which I saw about how frequently you want to sort of rebalance. Again, really personal preference. It depends what kind of investor you are. So we chose the 1 year rebalance just to keep it, you want to be assessing your stocks. Because we weren't including transaction costs within this study, it wasn't too problematic to be doing those buy and sells regularly. But realistically, you want to be considering that when you're rebalancing a portfolio. You don't want to be buying and selling unnecessarily. So for me personally, I'm very much a long-term investor. Comes down to personal circumstance, like what my savings goals, what do I want this money for? And for me, I mean, I probably look at my own portfolio way too infrequently. Just let it go, let it run. But the important thing here is sticking to your rules. So being disciplined about it. There have been some really interesting studies about this. There was one in particular, which Ed has talked about before, which I think it's a really interesting study, which showed that if a stock had a terrible share price performance, stocks had terrible share price performance, there were three different responses to that: either top up, sell, or do nothing. And the worst thing to do was do nothing. So either cutting your losses, selling, making a decision, like getting out, or topping up were the best outcomes. That study, I think they call them rabbits and something like that. That's what the study, and Ed's talked about it before, but I can find exactly what it was. But it's an interesting thing to do. But the key there is having your rules, having the discipline to stick to your rules. But making sure you're taking into account your personal circumstances when you're thinking about that rebalance period. Great. One more, and this one I think from Philip Fleming is probably a good place to end. What are the big takeaways from today? Keelan, do you want to give me one big takeaway, and then gives me time to think about my big takeaway?
Yeah, I think around the case studies, what we found is by taking a deeper dive into the data, the quantitative analysis, and carrying out that discretionary analysis as well with the qualitative aspects, doing your industry research about management, all of these other things that factor into your investment decision can really help you avoid the disaster stocks or improve your chances of picking the market darlings like plus 500 over the last decade. So whilst the improving your odds is all about the initial part, you can take that a step further by carrying out some further research yourself.
Yeah, absolutely. And I think for me, the thing that was really interesting was that sort of improving your odds with your screen. You're giving yourself a head start by selecting the right strategy that works for you. So I think that's my big takeaway. So unfortunately, we can't provide the exact answers for everybody, but they're providing some sort of frameworks and principles can hopefully allow people to go away and think about their own investing and setting your own rules, setting your own screens, your own strategies. But thank you everyone for joining, and thanks Keelan. That was hopefully a good first webinar. Somebody has just asked about details of the study. There is a lot of detail in the write-up, which is in the Academy, which is the links at the top of the chat box there, and we can follow up with the follow-up communications. We'll drop the link in there as well. So yeah, feel free to read it and ping us any more questions, any follow-up questions that you have. Thank you everybody, and have a great rest of your day.
Cheers everyone.